This is the strategy and framework that I trade every single day that made me profitable. This trade right here made me 18k, as you can see. But to be honest, we cook every day using this framework. You can see on stream, you can go on my channel, the live streams are still there. Monday and Tuesday both caught dubs using that exact same strategy of 6R a piece. So we do this shit every day and we do it live. You can see there's the execution there. There's the trade over 150 pips. Then you can see it closed out. We took a small loss just before, then closed out for just under 18k. So I'm going to be going over this, the framework behind it, and also my exact strategy. What made this trade even crazier is we actually came 1 pip away from stop loss, which is pretty mad. You can see less than a pip away from stop loss, and then price ended up rocketing 150 pips. So let's start off with something that's really important, and I'm going to go over this just before I actually tell you the strategy. But if you can't sit through this 30 seconds of me explaining a fucking crucial point in the market that 90% of people don't do, then just click off the video now, sign out of trading, because you're not going to make it. You've got TikTok brain, so just click off. Alright, but what's really important is indexes. And what indexes essentially are is the currency on its own. So we all know there's pairs like Euro USD, for example, right? But an index would be the US dollar on its own, or the euro on its own, the pound on its own, the yen on its own. And how it does that, it will be the US dollar against every single other major. So it'll be against the euro, against the pound, against AUD, against JPY, against NZD, against literally every single pair. So basically give a general overview of how the currency's doing. And this is fucking crucial to use. So they are best for dominant currencies, as you can see. Now, what do I mean by a dominant currency? What I mean by dominant currency are currencies mainly, really, there's nothing else really other than the dollar and the yen. Now, what I mean by a dominant currency is these basically dictate their respective pairs. So, for example, on these pairs, Euro USD and GBP USD, the euro and the pound sort of take a back seat, and whatever the dollar does is how the pair moves. Same for Euro JPY and GBP JPY. Irrespective of how strong or weak the euro or the pound is, it's going to move based on the JPY. And the dollar and the JPY are probably the two only pairs where this is actually really common. And this is basically how, if you don't know, how you can use them to dictate where your currencies are going to go. So, for example, the DXY, right? This is the US dollar index, and the JPY is called the yen basket. So let's look at the DXY. So if the DXY moves up, then Euro USD and GBP USD is going to move down. If US dollar index moves down, then EU GU is going to move up. So they basically have an inverse relationship with each other, right? Whatever this does, this will do the opposite. Very simple, and that's the same obviously for this as well, for Euro JPY and GBP JPY. So with that being said, the reason this is so powerful is because these indexes tend to trend a lot more than the currencies do, whereas the currencies sort of are controlled by a lot of news events and just sort of choppiness. The index is obviously more based on a certain country's economy, so you're going to get a trend in one, for example, which will go into the yen basket, which trends all the time and is such a heavy trend. So essentially, if you can predetermine a trend, for example, the JPY, well, we can predetermine that it's a really, really weak overall and just has been for years, then that means when we're trading the likes of Euro JPY or GBP JPY, we've barely even got to analyse the chart of Euro JPY, because we already know the yen basket's heading down, it's probably going to be biased. So it's not a matter of, oh, is Euro JPY going to go up or down? It's a matter of when is it going to go up, and just positioning myself for it to go up, which is also how you can catch really big runners as well. So indexes are really important. Obviously, as I said, this was like an 150 pip trade with a 20 pip stop loss. So you can really catch runners by doing this. So let's get into the framework of how you actually do this. So obviously it was the yen basket, and it was the crucial part. We'll start with the yen basket, and then we'll go all the way over to our Euro JPY, which was the trade we actually caught. So starting off with the yen basket, this is our blank chart that we're seeing when we're looking at it, and then we got this after we did all of our analysis, and we predicted this sell-off here. So you can see from here all the way down to here, this is the value that we caught, and that was what enabled us to make 18k from one trade. So let's start on the monthly time frame. The time frames I mainly look at: month, week, day, 4 hour. For indexes, you don't want to go on lower time frames for indexes. You want to stay on higher time frames. Remember, we're only really trying to find a trend. We're not massively looking for an actual setup within, for example. We're actually just looking at an overall trend and to give ourselves a solid direction. So first thing we do on the monthly is the eye test. Now that is basically just us looking at it and saying, cool, it's bearish. If you look at when this chart started, 2020 all the way to 2026, you can see we've basically been trending down, lower lows, lower highs, lower lows, lower highs consecutively, right? So we're essentially bearish looking at it. Now we're actually going to do a little bit of analysis, which is where our first concept comes in, and this is CRT. So this is where we have CRT on the weekly time frame, right, which means we're targeting this low. Now what is CRT? CRT is basically candle range theory, is where every candle is a range. And how we do it is we basically split it between candle A and candle B. Now, so first of all, we mark out candles A's highs and lows. Candle A is typically, you want it to be kind of a big candle. It doesn't have to be, but ideally it's a big candle like this. You then look for candle B to break out of the range and then close back within. Okay, so we broke out of candle A's range, but then closed back within. Now the reason this is important is because it showed that the bullish pressure failed and the bears then took control of the market again, and it can also show a manipulation of this range, where we're simply manipulating people to go long, and then we're actually going to show, obviously most people know by now, you need some type of manipulation before you can get a distribution. And once that happens, price will then target the opposing side of the range. So once we get that candlestick pattern, we are then targeting the opposing end of the range. So we can now target here, right? And as you can see, maybe not in the next candle, but the point is that eventually we will target this as our next target. And to be honest, it's really clear. I mean, even here we can see, for an example, we've got a candle A and we've got a candle B. So we mark out candle A's highs and lows. There's the high, there's the low. You can see candle B took out candle A's high and then closed back within the range, showing failed buyers and also manipulation. Therefore, the next candle targets the low. Very simple, and that's what we used on the weekly. As you can see, we have our candle A and we have our candle B, and candle A obviously made a range. This is the high, this is the low. Candle B tried to trade out of it, but then ended up closing back within. Now this is really nice on the weekly time frame, because obviously the higher up you go, the more relevance it has. As you can see, I don't actually have it written down, but I do use CRT on the monthly, weekly, daily, and 4 hour. Okay, these are the only time frames I'll use it on. I won't really go much lower than that because it starts getting less useful. But on the weekly, it's really nice because it shows you how the week's played out. So more than likely, at the start of the week, we tried to move higher to capitalize on this kind of bullish move. Tried to trade higher, didn't happen, ended up closing back within. So it basically tells us that we should target this low now. So already we've got our first target being this low. All right, that's number one. So now let's move on to the daily time frame. This is where we bring our second concept into it, which is internal and external liquidity. So first of all, you can see our weekly CRT high and low there. But now what we have also got is our internal and external liquidity. So this being our internal liquidity, this being our external liquidity. Now, again, what is internal and external liquidity? Well, the theory is basically this. Price only does two things. It'll move from internal to external liquidity or from external to internal liquidity. Right, now bear with me on this, but these are the only two things that price ever does. The only two things. It will never do anything else. Right? So let's break down and actually define what is external liquidity, what is internal liquidity in a clear way that you can understand and apply it. Again, this is one that I will use on the higher time frames, but the difference between this is you can also use this on the lower time frames. Any time frame you can apply this. Obviously for this example I applied it on the daily, which is, I always do this on the daily anyway. So cool. External. Now external is just your current range high and your current range low. So very easily defined. You haven't even got to think about it. The current range high, current range low. Okay. And internal is a point of interest within that range. Okay. So obviously this is our external. It's just a POI within this range. And for me, that is a fair value gap or an order block. Okay. So within this range, we've got our external, which is our high and low. And obviously a POI within, which is an order block, for example, right? And this is in essence how trends form, because it will go to internal liquidity and then to external, then to internal and then to external, right? And obviously you can see here, if we look at this chart, this is in essence how trends form. So you can see we go from internal and then target external. From external, we then target internal and then external again. And then from external, we target internal again and then we target external, and then internal again. And then the only time this fails is when we have a reversal, where we'll either go from internal again to internal, or if we go from external again to external, right? And this will obviously look something like this, where we have our internal, and we have our external high, external low. And rather than price moving off of our internal order block to our external low, it'll be too weak to get there, and instead we'll mitigate something from this recovery leg. So it'll go from internal to internal again, and then we'll target external, and then obviously it will continue from there. So it'll be only internal to internal once, and then again it'll be external, and then internal, and then external, and then internal, and external, until we reach a new trend or whatever we want to do. But that is internal and external. So let's break this down on this chart here. This is obviously our range for the M basket. This is our high, this is our low. So therefore we've got our external high and our external low. What are we interested in, this high or this low? Well, obviously we're interested in the low because we're clearly pre-established in a downtrend. All right, and we can see this from the daily time frame as well, breaking these lows. So we have our external low, which also happens to be our CRT low as well, which is a nice confluence. And then we also have our internal liquidity, which for me is an order block here on the daily time frame. You can also use this fair value gap if you wanted to. It's basically the same point, but this is the order block. A tip for this to use with your internal is you ideally want an internal within the premium or discount of the range, depending on what range it is. So what I mean by premium and discount is, say this is the range high, this is the range low, and this is the 50% line, so the equilibrium. If we're selling, we want a POI within the premium. If we're buying, we want a POI within the discount. Obviously, as we said, we're selling, you want to sell at a premium point. And it just narrows it down a bit, right? It means you're going to ignore all this price action and not going to be one of the dickheads that gets stopped out here. And then you're just going to make it a lot easier to focus on this, which was the correct one. So you can see, looking at this daily chart, we've got our external low, internal, so we want price to go from our internal order block down to our external low. Now you can start to see the theory behind back here, why we wanted price to go from here down to our low. Okay, so that was the daily, and now we're going on the 4 hour. Now all I'm really doing on the 4 hour is, as I said, with the indexes, you're not really trying to actually find a setup, you're just trying to find a trend, right? And what I'm doing on the 4 hours, not only am I trying to find the trend, because we've already really decided that that's bearish, what I'm actually trying to do is time myself and realize, because obviously we're bearish, yeah, but if you catch it on this side, you're still going to get cooked. So I basically want to see price action off of our internal, kind of just start to trend down, start to find a bit of structure. Again, internal, external, internal, external, right? So I just kind of want to see that trend a little bit start to form. Right, nothing too crazy, just evidence that we are starting to move down. And as you can see there, that's really what I did. As you can see, after we took our CRT high and tapped into our internal liquidity, we had a break of structure. So we took our external low, and then we come to our internal order block, and then again broke the low. So what I'm planning on now, after coming from that external, is we then come up to internal, and we get this move here, this move down, or this move down. And that's enough for me. Again, I'm not looking at anything really crazy. Again, if you look at this, you can see CRT. If you're starting to spot it, then you're starting to lock in. You're starting to see the secrets behind the market. But no, this is essentially all we need to see. We don't need to look at anything crazy, just kind of evidence that we're moving down. Right, so now we've looked at the M basket. Now we can actually start to build a setup. So the bias is clear. There's a high likelihood that Euro JPY and GBP JPY will move up. Why? As we said, if we go back to here, because we've established the M basket is bearish, so Euro JPY and GBP JPY should move in an opposite direction. Therefore, it makes it really, really easy. Why else? Because it's a dominant pair. So we know that Euro JPY should continue up, right? It's not about if, it's about when, really. It's just about timing ourselves and finding a setup. We can really relax, okay, and know that the odds are on our side. So let's move on again. Euro JPY from the weekly to the daily to the 4 hour to the 15 minute, and show you the entire thought behind it. So again, this should be easier to go through because you now know the concepts. If we look on the weekly, we have that same CRT that we had previously. As you can see, we've got our CRT candle A and then our candle B. And just as we did inversely on the M basket, we took out the low of Euro JPY and then closed back within the same candle's low that it just took. So we should target here, right? Again, so this is our value area that we're trying to actually catch. And again, if you actually look a bit closely, hopefully you can start to see how these setups tie in with each other. But you can see we also have an internal order block here, or you could use this one. Again, it kind of depends what you see. We do have an internal order block here, and then an external high here. So you can kind of start seeing these concepts on different time frames once you're sort of locked in with it. But let's move on to the daily, right? So now on the daily, we again do the exact same thing with the internal external as we did on here. So remember, all we did was go on the daily time frame, look for our internal external liquidity. Exact same thing we did here. So again, here's our CRT low, CRT high on the weekly. Here we have our daily low and our daily high. Not daily, but daily time frame, high and low, which is our range. So our external high being here, which again, similarly to the M basket, is the same as our CRT level or our CRT high. And we're looking at similar stuff basically. Again, order block and our external high. So we want to get price from this internal order block to this external high, oppositely to what we want on the M basket. Again, if you were to draw on the equilibrium and the 50%, you can see this POI was in the discount. Why does it want to be in the discount? Because we're looking to buy, and you want to buy at a discount and you want to sell at a premium. So again, would have helped you found the order block a little bit easier, or the internal a little bit easier. Now the 4 hour, we're kind of looking for similar things. I'm not looking for anything major because I'm already quite confirmed on my bias. But all I'm really looking for is, again, price to start moving in that direction and to have some type of internal, external confluence with that. So you can see this is price after we took our CRT low and tapped into our order block. So finally what we see here is price starts to break above these highs. So we've got these highs that have been sitting. Price has finally had a kind of decent leg to push above. So we've had a leg, and now obviously we've got this big candle, which is the retracement. Remember, every leg has a retracement. We move, we retrace, we move, we retrace, and we're always trying to catch it at the bottom of that retracement. Right, so this is the move, this is the retracement. So we're looking now for our internal liquidity to then try and catch, obviously, to our external. So again, keeping it very simple. Broke out these highs, we had a rally, and our internal is just an order block. You don't really want to overcomplicate this, all right? It's literally 5 candles. I mean, fuck me. It's pretty much drawn out for you. That was the order block we looked at. And now, as I said, chat, the reason I can be so clear on this, let me actually clarify this. The reason I can be kind of what would appear slapdash on this is because we've done our hard work on the M basket, right? We know basically where we're going. It's not about if we're going up, it's about when. Right, we know we're going to move up, so I'm not really going crazy. I'm just kind of looking for enough confluence for me to be like, yep, I'll pull the trigger for this to go higher. But yeah, so that's that. So now when we actually look at the setup itself, this is where we're kind of using time-based. Now, the way I like to look at the market is through the Asia session, London session, and New York session. The reason being is because each session normally has its own move. And when you draw out the sessions, or when you use this indicator, which actually shows the sessions individually, it makes that individual move a lot easier to see. Okay, rather than people that would view the market as just one continuous thing, this makes it a lot easier. So for example, this is how I kind of use that to build this setup. So we saw the Asia session was very strong. It pushed us back down to our order block, as we said. It was this retracement here which pushed us down. We then had the London session, which accumulated, so moved sideways, didn't really do anything. And at this point here, I was like, cool. So basically what I want to see, now I've seen this, is I want price to sweep the London low and fill this fair value gap made from the London session. Right, so again, let me just go over it. New York session sold off heavily at 7 AM, which is when the European/London session starts. 8 is London, 7 is European Central Bank Open. So 7 AM, which is the end of this, after the sell-off, we get what? We get a nice reaction off of our order block, okay? We get a nice reaction which leaves a fair value gap behind. And obviously the London session basically does fuck all. It doesn't retrace back into it and then move. It just sits there and doesn't move. So once that happens, kind of frustrating. This actually was that loss that you saw earlier. That is what I call a loss. Price was just chopping around, which caused this loss right here. I basically wanted that liquidity to get taken. So I looked at that. saying, cool, this is our accumulation. Want the New York session to open, stop all these people out, move higher with a fair value gap, and then tap back in and enter, right? Or enter off of that fair value gap. So that was my bias. Sweep of the low, fair value gap, very simple. Again, not really doing anything too crazy. I just made it easy on myself because I've already looked at the end basket. If you want to know how I normally enter, it will be a fair value gap or an IFVG. So this one was a normal fair value gap, but often I do actually prefer an inversion fair value gap. If you don't know what that is basically this. So it's our confirmation, and we use it on the 30-minute, 15-minute, and 5-minute. Now, what we see here, for example, is a fair value gap, right? Simple fair value gap that everyone knows, and we should tap in and continue to move higher as we previously did. So fair value gap here, we should tap in and move higher, tap in and move higher. That's what we should do at a fair value gap. So instead, we close below, keyword being close. Instead, price comes in and closes below, right? This tells us that this bullish order flow is no longer going to continue, and we're actually going to be moving in line with a bearish order flow. Now, this is kind of pointless on its own, but if you added in your higher time frame, so for example, your internal liquidity on the 4-hour, and you've got this on the 30-minute, for example, then it's a lot more. Of a confluence, because you can see after hitting our key point, this bullish order flow is now stopped, and we're starting to see a reversal, right? And what I typically do with that is I'll have my entry on 50% of the retap. So I want it to retap and come down. Hence the name an inversion fair value gap, because this inverts from being a bullish gap to now we want to treat it the opposite, which is a bearish gap. We want it to tap in and move down. All right, so that's basically like the other way that I used to get in. But this one was just a simple, normal fair value gap, right? Very simple. I had my stop loss of 20 pips. Again, I was trying to hold this one quite heavily. So I had a stop of 20 pips, entry on the bottom of the fair value gap, and yeah, I'll show you where I put my TP. And again, I'm so relaxed going into this trade. Like, I can't explain to you how relaxed I am, because I know, like, looking at this fucking chart, what are the chances, realistically, chat, that we fucking don't move down? What are the chances that we start going like this when we've just seen this? Like, we're so confirmed that the yen basket's moving down that this is just so risk off and is so much more relaxed when entering the trade. And what that relaxation does is it enables you to hold for bigger runners and also hold through bullshit that you'd normally close over. For example, holding when price comes 1 pip away from your stop loss, still not worried, because I know the odds are on my favour. We're probably going to move up, right? And again, it's another reason why I was able to take this loss on a buy and still jump in again and manage to secure about fucking 10 times what I lost. Alright, so my TP placement, which is the final thing. Where are we? The TP. So obviously we've got our external high on the daily, and we've got this is also our 1 week CRT high. So this is obviously the high we're targeting. Now the reason I aim for this high here rather than this high is just due to something we call basically time to reward ratio, right? So we don't want to be in the trade at a stupid time. Now, if we look at what's going on, again, if we look at the equilibrium or whatever you want to do, essentially, we've got a lot of room to move up, right? But when we start getting to the high of this range, this is where we're going to get sellers start to step in. And people are going to have limits set in, or they're going to be marking out POIs, looking to get in sells. So essentially, right, what we're likely to do, and I've seen this so many times, is move up quite quickly as we're moving from the lower to kind of the midpoint of the range. But then once we do get into the premium, people are going to start selling, right? And I do still think we're going to continue up, but what it means is it's probably going to start moving like this. We may have a bit of drawdown, a bit of manipulation, and then eventually we'll come through. So basically the bias is if this trade takes us, for example, 1 day to get to here, and that secures us, obviously this one was 9%. So if it took us 1 day to secure 9%, are we really going to want to hold for another like 9 or another, say, 7 days, however long this may take, for another extra 5%, right? So we've been in for a day and got 9%. Do we want to hold for another 7 days for an extra 5%? Doesn't really make sense to do that, right? It's like we've already secured 9%. I'm not going to hold for fucking 5 times the amount of time for like half the profit we've already made. Just doesn't make sense. And that was something I could kind of see happening, which did actually happen in the end, to be fair. So yeah, that was That was the trade there, and as you can see, that is where we ended up closing it out at that high there, and it ended up generating us a very nice 17k, which is really, really nice. And hopefully you can see the importance of indexes and just overall my higher time frame outlook from start to finish and how I actually catch trades. So if you do want me to send you over this PDF where we have all the concepts and this trade in particular, but all of the concept written out and explained the same way I did in this video, then comment PDF along with your Instagram at, and I'm going to send you a DM of this exact PDF so you have it all there for you and you can make notes and lock in. Other than that, boys, I am live every single day trading this strategy. As I said, I was live this week and we caught this trade on Monday and this trade on Tuesday. Both would have been 6R a piece and 6R a piece. I also do have a signal group as well. These two trades were sent into the signal group, which is really, really nice. Really nice to get that dub in the chat as well as obviously with the members. So if you are interested in that, then I'll leave a link down below to my signal group and also to my mentorship so you can look at whichever one you want. I'm live every single day at 8:30 as well, so if you are looking to watch me live trade, then you can go on YouTube, go on my channel, and I'm live there every single day, trading the entire session all the way to 4 PM. So I appreciate you, man, watching, and I'll catch you in the next video or stream, people. Sweet.